We've given them a carrot, more homes, they're getting a ton of money.
The mood was light in Etobicoke this morning as leaders from all levels of government put their political stripes aside for a joint announcement meant to solve an issue the home building industry has grappled with in recent years: the development charges they have to pay cities for infrastructure.
They become, over time, a major hurdle in this housing market. In recent years, they've been growing at an unsustainable rate, increasing the cost of every new home, compressing margins for builders, and they've been stalling new builds, stalling construction.
The province and Ottawa are spending $4.4 billion each on housing-related infrastructure over the next 10 years, a deal meant to cut development charges in half for 3 years, something the industry has been looking for.
Something big just happened that most people in Canada either missed entirely or dismissed as routine political theater. Mark Carney and Doug Ford stood in front of cameras together, announced an $8.8 billion housing infrastructure deal. And the two of them looked like they were genuinely enjoying the moment. That image matters more than the dollar figure, because what it represents, a federal Liberal Prime Minister and an Ontario Progressive Conservative Premier building real policy together in the middle of a trade war, is the kind of governance that produces durable economic outcomes. And the economic data coming out of Canada right now suggests that approach is working in ways that deserve more attention than they are getting. The housing deal breaks down into a straightforward structure. The federal and provincial governments each commit $4.4 billion to housing-related infrastructure over the next decade. Simultaneously, development charges the fees. Municipalities' levy on builders to fund the roads, sewers, and water systems that new housing requires are being cut in half for 3 years. The logic is direct development charges, when passed fully onto builders, get embedded in the final price of every new unit buyers end up paying for municipal infrastructure through elevated purchase prices rather than through spread tax mechanisms. Cut those charges in half, and the cost pressure on new construction reduces. More approvals follow, more supply enters the market, the price trajectory adjusts. And Canada's housing price trajectory has already been adjusting. The national average home price dropped from $694,000 to $661,000 in the year ending February 2026. That is not a collapse. It is a sustained, controlled decline in a market that was badly distorted during the pandemic-era interest rate period, when prices ran from approximately $535,000 to a peak of $828,000 between 2020 and 2022, looked at over a full decade. The actual compounded increase in Canadian home prices has been roughly 44%, meaning an average home that cost $457,000 10 years ago now costs $661,000. That is approximately 4.4% per year, a figure consistent with what functional housing markets have historically produced. The 2020 to 2022 spike was the distortion. The current trend is a correction back toward the long-term baseline, and supply-side policy is actively supporting that correction rather than fighting it. Carney's Quebec announcement added a different dimension to the investment picture. A $3.8 billion national nature strategy focused on creating new conservation areas and urban parks was announced alongside a funding model that drew attention from observers across the private sector. The strategy leans on private capital, corporate partnerships, and investor contributions to conservation financing alongside government spending. The concept is straightforward: major Canadian corporations with brand recognition and public-facing reputations co-fund conservation infrastructure in exchange for naming rights and associated visibility. It is a model already proven in sports and cultural institutions, now being applied to the country's natural assets. Whether the private participation materializes at scale remains to be seen, but the structural intention is to reduce the ongoing public subsidy burden by activating capital that currently sits outside the conservation funding system entirely. Beyond the specific announcements, the data environment that surrounds Canadian economic policy right now tells a broader story, one that only becomes legible when you look at bond market yields across comparable economies simultaneously. Canada's 10-year government bond yield is currently sitting at approximately 3.4%. The United States 10-year is at roughly 4.5%. That gap, a full percentage point, is not a technicality. It reflects a direct and ongoing judgment by global investors about the relative risk of holding each country's debt. When investors demand a higher yield, they're expressing less confidence in either the currency stability, fiscal discipline, or long-term economic trajectory of the borrowing country. The US dollar has depreciated approximately 10% against a basket of world currencies. Over the past year alone, foreign holders of US Treasury securities denominated in dollars have watched their returns erode in real terms by that same amount. When your currency loses value, investors demand higher nominal yields to compensate. That is exactly what is happening in the United States Treasury market right now. Canada's 10-year yield at 3.4% places it in favorable company globally. France is at approximately 3.7%. Italy sits at roughly 3.9%. The United Kingdom is around 4.8% higher than the United States. Germany's 10-year yield, the benchmark for Europe's most financially stable economy, sits just below. 3%. Canada is positioned between Germany and France in the global risk hierarchy for a country that has spent most of its recent history assuming the United States would always be the safe harbor. And the benchmark, that positioning, represents a structural shift in how international capital evaluates North American fiscal credibility. For contrast, Chile's 10-year bond yield is at approximately 5.5. 6%. South Africa's is above 9%. Russia, under sustained Western sanctions since the Ukraine invasion, carries a 10-year yield above 14%. Switzerland, the global standard for monetary stability, sits below 1.4%. These numbers form a map of global investor confidence, and Canada sits in the upper tier of that map above every major English-speaking economy, except Germany's European anchor. The outlier in the global bond data is China. A decade ago, China's 10-year government bond yield was around 4%, roughly aligned with Canada and the United States. Today, it sits at approximately 1.82%, has been declining steadily for years. A yield that low reflects extraordinary investor confidence in the stability and trajectory of the Chinese economy. It means China can borrow money at rates approaching what Switzerland charges, which enables infrastructure, investment, industrial policy, and strategic positioning at a cost that most economies cannot replicate. Understanding why China's yield is moving in the opposite direction from the United States at this particular moment in history is essential context for understanding why Canada's trade diversification strategy is not idealistic positioning, but rational economic response to visible data. The practical implication for Canadians is this: the bond market tells you something that political speeches cannot be used to fake Canada's 10-year yield at 3.4% versus the United States at 4.5%. Means that when the Canadian government borrows money to fund infrastructure, including the housing programs, the conservation strategy, the broadband investments, it borrows more cheaply than Washington does. Lower borrowing costs compound. Over time, they allow more investment per public dollar spent. They reduce the fiscal drag that high debt service costs impose on government budgets. They signal to private investors that the regulatory and fiscal environment is stable enough to justify long-term capital commitments. The housing data and the bond data together tell a consistent story. Canada's average home price is declining at a controlled pace toward a sustainable long-term trend. Its government borrowing costs are among the lowest in the developed world. Its federal and provincial governments are deploying joint infrastructure capital at scale, and its prime minister is actively building trade relationships across Asia, Europe, and South America to reduce the dependency on a single trading partner that the past several decades of economic integration created. That last point is where the bond data intersects with trade policy most directly. A country that does 75% of its export trade through one border is carrying a concentration risk that shows up in bond market pricing the moment that relationship becomes unstable. Canada's yield remaining relatively stable through over a year of active trade conflict with the United States reflects two things simultaneously: the market's confidence in Canadian fiscal management and its recognition that Canada has been actively working to reduce the exposure that made the instability possible. The $8.8 billion housing commitment, the $3.8 billion nature strategy, the federal-provincial coordination framework. These are not isolated announcements. They are components of an economic positioning that the bond market is already pricing. Canada sits at 3.4%. The United States sits at 4.5%. That gap is the market's verdict on where each country is heading, and right now the trajectory is pointing in different directions.